regards to not just what you have, but what you can go ahead and create for yourself financially. So we're going to go ahead and do a really deep dive into a really good subject, which is, of course, the index universal life policies. Very, very popular policies. I would say about 95% of them that I have seen people send me, they are trash. They're actually trash products that were set up for you all because you may think that just because, again, there's a title that you have, that, of course, oh, goodness, that, of course, that it should work out for you. And more than likely, it just doesn't work that way. Okay. So I'm going to do a deep breakdown. Hopefully you all can see my screen and it makes sense. Okay, there we go. So let's go ahead and let's hop right into it. We're not going to just talk about the index universal life policies, but you can't talk about an index universal life policy unless you're talking about a max funded index universal life policy. So you have to understand how these products work to the fullest in order for you to understand, okay, why are a lot of people skeptical of these types of vehicles? And I'm going to explain why in a minute. But we're not just talking about a traditional index universal life policy. I want you to understand we're talking about a max funded. Those are two different things. Yesterday, we talked about people that are putting the minimum, the bare minimum of whatever the insurance is. They're taking advantage of whatever the insurance company says the minimum is. And we don't want to be those people. We want to be the people that's taking advantage of whatever the maximum is. What is the maximum that the government said that we can put towards these vehicles? So there's two types of mindsets when you're having these conversations. Now, when you're talking about, of course, these vehicles, you have to talk about taxes. You have to talk about taxes because it's the number one secret to the index universal life policy. Most people do not know how to grow their money tax free and still have it be in a situation where it can grow based on the markets. So the number one secret to having an index universal life policy is to be in a situation to where you can eliminate taxes, and number two, you can eliminate losses. So what do I mean by losses? A lot of you all, you have 401k portfolios, you have money in the market, you got money in crypto, you have money pretty much sitting everywhere, right? And there are two ways that your money has been exposed. Number one has been exposed through taxation. And then the other way is being exposed through losses, market volatility. The money is going just like this. If you have 500,000 in your account, you lose 10%. That's 50,000 that you just lost. The advisor tells you, hey, listen, it's all right. It's just a paper loss. Keep that money there. It's going to go up in the future. But you're like, oh my goodness, no, I'm supposed to be retiring in the next 2, 3, 4, 5 years. I can't afford to lose $50,000. I can't afford to predict that it's going to happen. One thing I really want people to understand, I want you to put yourself in the mindset of understanding that just because something has no ceiling, okay, meaning you can make as much money as possible, it has no ceiling, it also means that it has no floor. So that means that you can lose all the money as well. So when you're having these conversations with people talking about you're going to have 10,000% returns, understand that you're going to have a negative effect of that return. That is how investing works. That is how putting your money in certain vehicles work. So when you're dealing with index universal life policies, it guarantees you a zero loss provision, meaning I can't lose money based on market volatility. Now, the reason why taxes are important is because you already understand that number one is not going to be lower. Number two, it's not going to stay the same. Number three, it's going to go higher. Well, why will it go higher? Is because everything is getting more expensive. When people are having these conversations, it's just so funny to hear people talk about how they bought a house in the 1950s and now it's worth this amount of money. Well, if you bought a house for $20,000 in the 1950s and now it's worth 200,000, you got to understand that everything else is now worth more too. So the conversation that people are having when it comes down to that, I just don't get it. Gas is also higher too. Everything else went up. So that means if your house is worth more, that means that the dollar that you're spending is also worth more as well. So that means that whatever you used to buy for $1 is not the same. It's going to take you a couple of dollars. Okay, I grew up in Atlanta. We had candy ladies. You could go spend 10 cents for just a sucker or something, 5 cents on candy. Now you got to spend a whole dollar. Well, why do you have to spend a whole dollar? Because inflation, every single thing went up over time. So why do you think taxes won't go up if everything went up? If you've been alive for the last 10 years, you've seen things go up. You've seen iPhones go up. You've seen everything go up. And guess what? You're going to pay it. Most people say, I'm not going to spend my money. Yes, you will. You're going to pay it. But I want you to understand the value of things going up, not because you want to go ahead and just spend your money, but because you need to be in a situation where you understand the leverage of money. The leverage of money is always going to be compounding. Compounding. If we look at a dollar and we double a dollar 20 times, let's do class participation. If I double a dollar 20 times, okay, and I compound it 20 times, where do you think I would be? Drop it in the chat. Where do you think I would be if I doubled the dollar 20 times? If I doubled the dollar 20 times, where do you think I would be? Quick icebreaker. What do you think I would be if I doubled my dollar 20 times? Let's see. Somebody said $40. Come on, keep the answers coming. Okay, $100. $100. Keep them coming. Keep them coming. I'm sorry, $100,000. Somebody said $200. Somebody said $40, right? Perfect. These are great answers. I'm going to show you exactly where you're going to be. If you double the dollar 20 times, you're going to be in a situation to where if you compound it, it's going to be at $1 million. If you double $1 20 times, this is the power of compound interest. Taking advantage of compound interest is going to be your lifesaver. Most people that are multimillionaires and really, really wealthy without having to work, meaning you got multiple people, you got different types of wealth. You have people that are making money off businesses, and you also have people that are making money off money. Okay? The people that learn how to make money off the money that they've earned throughout their lifetime are typically the most, how can I put it, stress-free wealth, because they're making money off of their money. They decided to say, I'm going to take this dollar and I'm going to trust that this dollar is going to grow over time. Why is it that your parents had a 401k portfolio and they did not invest into Google? They did not invest into Windows. They did not invest into companies that we all purchase. If you take the opportunity to take your dollar and invest into vehicles to where you're already putting your money, more than likely in the next 20 years is going to compound just exactly how this is compounding. So if you simply want to know where to put your money, more than likely just look at what you're already buying. That's the simplest way. People are like, oh, where should I put my money? Put it where you're already buying. Are you riding in Uber? Invest into Uber. Do you shop at this store? Invest into this store. Do you purchase these items? There's no need in you just spending your money without understanding that you could take the money and actually invest into the company. And over time, if you take that same amount of money, guess what? It's going to do this. So a lot of you have said $100,000 to $40. This is the power of compound interest. Now, here's the power of being taxed on your compound interest. If you were taxed 25% on every dollar that was compounded, now you're left with what? $72,000. This is the power of being taxed on compounding. Most people don't understand that you're in business with the government. When you make a decision to say, I'm going to get I'm going to be born in this country and I'm going to get a social security number, you're now in business with the government. If you look at every other nation on earth, there's no other nations that are built like America. America just so happened to be built like a business. As Americans, we are business partners with America. There's a part that we have to play to make sure that we're running this company in a great manner. If you look at America, America also separates their businesses based on departments. If you look at your life, you also separate your life based on departments. If you look at other countries do not have a system structure just like America. So when people always say, oh, we got this, we got the other countries, they have this and that. There is no country like America because America is the only country that is literally structured like a business to where they have a president. If you go look at Tim Cook, he just stepped down as the CEO of Apple. What was he? The CEO, the president. If you go look at the same thing in regards to the countries have presidents just like we do. Countries have departments just like businesses do. They have departments. So when you're talking about taxes, that just means that you are a business partner with the government. Now, depending upon how you're getting taxed determines how your value is to the government. So if you're getting taxed a certain percentage on your dollar, that means you're more than likely are not as valuable to the government as you think you are. That's why when you decide to have a business or you decide to put your money into insurance policies or you decide to put your money into real estate, those types of people, they don't pay any taxes on those dollars. But if you decide to just go to work and get paid, you're now going to just be taxed because they're going to judge you based on your value that you bring to the company. The people that create jobs are typically those people who don't have to pay a lot in taxes. Okay. So I want you to understand you also have the ability to take advantage of it because the people who put their money in certain areas also don't have to pay certain taxes. Okay. Now let's look at, of course, if we were to break this down a little bit more, 33%, right? You're going to be left with 27,000. So with no taxes, we were left with $1 million. Now with taxes, we're left with 27,000. I want you to think about a farmer, right? If you were a farmer, if you're in a situation to where you were a farmer and you said, hey, listen, I want to be taxed. Do I want to be taxed on the seed or I want to be taxed on the harvest? Most people would say, hey, listen, I don't want to be taxed on the seed. Okay. I don't want to be taxed on the harvest. But I'm going to tell you what's happening. When you're putting your money into 401ks, mutual funds, IRAs, you're saying, I want to be taxed on the harvest. Tax me on whatever is grown over time. This is what you're saying when you put your money into these vehicles, because they're not taxing you when you put the money in. They're taxing you after you take it out and it's already grown. That's what happens. So the number one secret again is to eliminate taxes and losses. Now, if you look at people like Warren Buffett, he's in a situation where he's a very successful investor. He's a very successful person when he's putting his money in places, aka insurance companies. That's what he's investing in. You will see that his number one rule is to not lose the money. And then his number two rule is to not forget the rule of number one. If you look at what's happening when you're having conversations with these advisors, they're going to tell you exactly what's happening, They're going to show you whatever the average rate of return is. Let's say your market grew 50%. If the market grew 50% year one, and then the market dropped down year two, 50%, and then the next year it grows 50%, and then the next year it drops down 50%, guess what? You've averaged over 4 years of 0%. But they're not going to tell you that. They're only going to sit down with you and tell you, hey, look, you grew 50% this year. Don't worry about the year that you lost 50%, but you grew 50%. But in reality, you really didn't grow anything. So what I mean, as a visual, I'm going to show you exactly how this looks. Let's say we start off with $100,000. Okay. We start off with $100,000 and we grow 50%. And now we're in a situation where we have $150,000. Well, guess what? The market just did a retracement. And when a market does that retracement, and remember what I told you, if you have no ceiling, you also have no floor. So because that market did that retracement, it's gonna drop another 50%. Now you're lower than whatever you started. Now you're at 75,000. But guess what? The markets are up. COVID is over. Bitcoin is booming. Now we're up another 50%. And now we're in a situation to where we're at 112,000. When I learned this, when I first got started in the finance space, I got started in the markets. And when I understood, I would see people's screenshots, I would see exactly what people were posting. I was like, man, these people are ridiculous. They're not making a dollar. I've seen people literally deposit 10, 15, 30,000 into their accounts, but they would just lose it. It's like gambling. You go to the gambling place and you put up thousands of dollars, and then you lose those thousands of dollars. Then you make it back, and then you're so excited, and then you walk away from the table feeling like you won. In reality, you didn't win anything. You just took your money back. That is the name of the game. So you all are in a situation to where you're playing a game and you're not really winning. You're not winning at all. People are playing on your emotions. Okay. So let's look at it here. Let's say now you're at 120, 112,000. Then you lost another 50%. Now you're at 56,000. This is what a portfolio is looking like. Let's look at what the S&P 500 did in 2000 to 2020. These are real numbers. These are real numbers of what it did. 8.9%, 2%, 17%, 24%. Low. Those are negatives. Okay. The red is negative. The green is positive. So let's take a really quick look at how this looks. This is where people are putting their money. And they're not doing, remember I told you yesterday, there's a difference between actual return, look at this word here, actual return, and average return. Okay. So when you're talking to your advisors, you want to understand that there's a language barrier. The average return over 20 years is 5.6%. But the actual return is really 3.1%. And this is the S&P 500. This is where majority of people's money is. The number two secret of having an index universal life policy, a max funded, is understanding that you have the opportunity to optimize on the gains. Why? Because you're not losing anything. You're not losing anything over time. See, when you begin to max fund over time, it's a totally different structure. You can still have the same chart, but be in a situation when you take advantage, you're in the blue, you're not in the red. So what does that look like here? I want you guys to pay very close attention to this, and I'm gonna show you another visual in just a second. Let's just say, for example, we started off with this $330,000. We started off with $330,000 in the S&P 500 in 2000. By the time we get done, we will be at $1 million. These are real actual numbers. We'll be at $1 million. Why? Because we didn't have a retracement along the way. We only took advantage of the growth. So meaning we only take advantage of the growth of the market. We don't take any disadvantages of the market when you're dealing with the index universal life policy because it's a zero downturn potential. Or Ken, what happens when you don't earn anything? Well, guess what? You don't lose anything. I'd rather not earn anything, okay, than lose something that I just earned. So when you don't lose, this is the power of not losing. So most people will tell you, well, guess what? You're not going to earn it. You didn't earn anything for the last 3 years. Well, guess what? The market's been tanking for the last 3 years too. So there's a big difference. Okay, let me show you exactly what that difference would look like. Let me see if I can do this here. See if I do this here. If we're in a situation to where, of course, we have, let's just say 50,000. Let's just say 50,000, right? We got $50,000 and we say, you know what? We want a compound interest over the next 5 years. Okay. Next 5 years. Over the next 5 years, that 5,000, I'm sorry, that $50,000 compound interest 5% is going to gain you about $14,000. In 5 years, you're going to have 64,000. Okay. Now, let's say, for example, we decide to contribute. We decide to contribute $1,000 a month. Okay. Over the next 5 years. Now we're in a situation where that same 5% now has earned us 22,000. Now, let's say, for example, remember I showed you a penny doubled over a certain period of time. Let's go back. If I show you a penny doubled over a certain period of time, if you notice when it came down to the penny, it didn't really start moving in the beginning. So in the beginning, it was $2, $4, $8, $16. Like, this is slow money, slow money. Oh my goodness. It took you 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times just to get to $1,000. And then not only did it take you 10 times to get to $1,000, it also took you 11, 12, 13, 14, 15, 16. It took you 17 times to be doubled to get to 6 figures. 17 times. It really only started to make sense once you got to number 17. The first 17 doubles, it was like, what is happening here? My money isn't doing anything. That's the power of compound interest. That's the secret of compound interest. Let's look at it here. You're in a situation to where, okay, the first 5 years, it may not make sense. What am I going to do with $22,000? But by the time we get to, I mean, 30 years are coming anyway. By the time we get to 30 years, okay, yeah, dollar, I'm sorry. By the time we get to 30 years, now we're looking, and the interest that's earned is 645,000 off of that same $1,000 that we're putting on a monthly contribution. Okay. Off of what? 5%. Remember, your average return was 5%. Your actual return was what? 3%. So we're not looking at getting any crazy percentages. We're looking at getting really steady average percentages. We're not looking at doing anything crazy. So 5%, that's really just on the low end. Okay. So just so you have a clear visual of how that works. Okay. Now, if you don't want to do that, and that's just putting that together over the next 30 years of where you would be. Your final balance will be about $1 million. That means that on average, every year, by the time you get to that 30th year, now you're earning $50,000 in interest for that particular year. Okay. That's the power of compound interest. Now, let's go back. See if we can go back here. Boom, 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 boom. Now, let's look at if you're in a situation where accessing your money within your account. Now, remember, when I said when you're dealing with the index universal life policy, it's just a little bit different. It's a little bit different because you're in a situation to where you're earning interest on your money, but you have what we call a accumulated value. So let's just say, for example, at the time, of course, you have your money accumulated over time. Let's just say we got we got $1 million in the account value. Okay. The index fund, of course, grew 10%. 10% grew in that particular account. Now your account value is at $1,100,000. Okay, stick with me. Now you're in a situation to where $100,000 is what you would want access to. That $100,000 is what you just did, of course, a policy loan on. So let's say we take $100,000. We take $100,000 from our $1.1 million. That's what we just took out. Now we have liquid to do a policy loan on $1 million. But guess what? Our account value is still going to be $1.1 million. Okay, how is it 1.1 million? Because remember, we did loans. We did not do withdrawals. We did loans. So we borrowed against that $1 million. When we made the decision to borrow against that $1 million, guess what? That 100,000, okay, let's just say the insurance company says we're going to charge you that 4.5% for borrowing from that account, and over time you didn't pay that money back. Guess what? Over time, the $1.1 million is still sitting in the index account. You're in a situation to where it grew 10% for that year. While your $100,000 is over here doing what it's doing, now your 1.1 million still grew to 1.2 million. Why? Because we did a policy loan on this 100,000. Now, guess what? You're in a situation to where your liquid value over time is $1.1 million, even though you still took from that account. I'll do another example soon. Now, you want to be in a situation to where when you're taking advantage of these vehicles, you maximize these vehicles as much as possible. Well, what do you mean by maximizing these vehicles? Let's say you're in a situation to where you own an apartment building. You own an apartment building, and this building has 5 floors. If you're a good business person, you want to fill up the whole entire floor. You don't want to have any vacancies. This is exactly how the index universal life policy works. The reason why it works the way that it works is because, of course, it is backed by the IRS. The IRS has several codes that say we're not going to tax you on the money that you're putting in over time. Even if you borrow from it, we're still not going to tax you. The first IRS code is going to be 101A, which allows it to be tax-free. That means that the money that you're putting in is going to be tax-free. We're not going to treat it like your traditional IRAs or your 401ks. Okay. Secondly, it's going to be 72E, meaning that it's going to grow. That 10% that you're growing is going to be tax-free. So when you go to Fidelity, you go to Charles Schwab, these people are not giving you 10% tax-free. Number three, tax code number three, 7702 is access tax-free, which is the biggest one. The biggest one is the 7702. I'm going to tell you right now, here's a secret. A lot of people that are very, very smart, okay, very, very smart, are storing their money into insurance policies. And when they store the money into insurance policies, they use these very specific tax codes in everything. Um, let's say, for example, you're in a situation where, of course, a creditor or whoever is trying to sue, and they say this person has money in their insurance policy. Well, the conversation usually goes like this. Okay, well, that isn't necessarily his money in the insurance policy. Yes, it is. He's the owner. He's putting money into the insurance policy. You say, Your Honor, no, that isn't my money because I have a beneficiary on that insurance policy. And that is where that money is supposed to go. And if you, Your Honor, force me to take that money out of that insurance policy, it could possibly lapse the insurance policy to where the beneficiary of the insurance policy cannot receive the money. There's so many people that utilize this code to just put money into their insurance. And when it's time for, for people to go bankrupt or anything like that, it's very rare that anyone will try to attack taking the money from the insurance. Because guess what? It's based on who you have made your beneficiary. I just want to give you guys that. Okay. So this type of insurance policy can be compared to owning an apartment building or running your own business. Again, you want to max fund it. So you're utilizing the tax codes of TEFRA, DEFRA, and TAMRA to necessarily utilize this. Now let's look at a $1 million policy, self-funded. If you wanted to self-fund your insurance, more than likely at the age of 35 years old, you're going to have to spend about $250,000. $215,000 to be able to fund up to $1 million policy. The longer you wait, the more money you're going to have to put in. This is the power of compound interest. And this is why you need to start early. So if I wanted to compound to $1 million as soon as possible, I want to start as early. So the average 35-year-old only need to contribute $215,000, while the 55-year-old need to contribute $412,000, while the 75-year-old need to contribute $740,000. So this is why it's very important to try to take advantage of it as soon as possible. All right, drop some ones in the chat if you're still with me. Drop some ones if you're still with me. There we go. So we can break down into lesson 2. Let's see. Now, remember we talked about, oh, no, not this one. Sorry. Can we dig over this? The max funded index universal life policy. Oh, these are the same. You want to understand that when you take advantage of these particular policies, you want to know exactly how they work. So what do I mean by how they work? I want you to pay very close attention. I want to see if I can break this down to you as simple as possible. You want to pay very close attention when you're dealing with index universal life policies because, again, they're in the bubble of dealing with, of course, again, those IRAs, 401ks, mutual funds. Typically, when people are having these conversations, I typically only suggest them if we're in a situation where we're building up for retirement. Okay. because you're gonna need to allow that remember the compound interest model. So a lot of people, they say, well, my index universal life policy is not making sense. Well, you just got it a couple months ago. Okay, it's going to take time for it to build up and for it to make sense. You have to think long term. These are long term vehicles. You don't go get your 401k and retire tomorrow. So why would you expect to get your insurance policy and retire tomorrow? It doesn't make sense, right? So I want you to really take the time to really look at why ignorance tax is your biggest tax that you're going to pay. Most people are paying the biggest ignorance tax of not knowing what they don't know and saying that you don't know what you don't know. Everybody says if you don't know what you don't know, and then they just use it as an excuse as not to know. I'm going to show you exactly why it's very important to know exactly what I'm talking about and how it's going to save you hundreds of thousands of dollars, even millions. Okay. So let's just say, for example, we're in a situation. Let's reset here. Let's say, for example, we're in a situation to where you're getting matched, let's say $1,500 or a certain percentage. I don't know. Let's say a certain percentage. Let's say this is going to be your 401k. The blue is going to be your 401k. Okay. The average fees that you're going to pay on that 401k is going to be about 2.5%. Okay. Over time, you're contributing, over time, including the match, you're contributing $10,000 a year into the 401k. Okay. Over here is going to be your index universal life policy. This is going to be you in a situation to where you're funding $6,000 a year of your hard-earned money into this vehicle. Over here is still your hard-earned money, but here it's just, again, we're not taking advantage of the system that is created. We created our own system, okay? Now, at the age of 30, this is when we started this vehicle. Our goal is by 65 to figure out where we would be. I'm going to show you exactly where you would be. 15 years down the line, you've contributed to both accounts. The first account, you've contributed about $160,000. The second account, you've contributed $96,000. Now, when you've contributed this $96,000 over time, again, there were you've already paid taxes on this money, but there are also fees that are associated with the index universal life policy. Out of the $96,000, $17,000 went towards the fees. Right now, your death benefit is going to be $387,000. That means if anything was to happen at age 45, that person was to pass away, they put in 96,000, but the family is going to get 387,000. Okay? Over time, you put in 96,000, but guess what? The balance, the amount of money that you have to pretty much take out, withdraw, whatever you want to do, is going to be 139,000. And we're just at 45 years old. Okay? These are real numbers, real stuff. Okay? Let's just say we get up to about 59 and a half, 60 years old. Now we're at 60 years old. Okay? In the 401k, we have not touched our money yet. We are just now able to touch our money. Remember, in the 401k, you can only touch your money until 59 and a half without being penalized on it. So we don't want to be penalized. We contributed $310,000. Okay? We contributed $310,000. Over here, we've contributed $186,000. Let's do a review. We're at 60 years old now. Our fees that we've paid into the index universal is $44,000. Oh my God, $44,000. That sounds like a lot for fees. Okay, just stick with me. The death benefit is $758,000. Okay, so you put in $186,000. Your death benefit is $758,000. Anything happens, your family is going to get $758,000. Your account balance, the money that you could take out, is going to be $510,000. Okay, now let's get to a point to where now let's just go ahead and jump to retirement. We jump to retirement. We're at 65 years old. At 65 years old, let me make sure I add this on here. Give me 1 second. Hold on. All right, 2 seconds. Hold on. Something I did wrong. Sorry. Hold on. Fees. Where are the fees? The fees. Maybe it's not on here. Mm. 2 seconds. Hold on. Okay. Now, let's just say now we're at 65 years old. We start taking out money. Now, our whole goal here is to make sure that we do not outlive our money. Okay. We do not want to outlive our money. That's the whole purpose of retirement. That's the scariest thing. That's why people have to go back to work because they're outliving their money. Okay. Now let's go back here over this scenario. Let's just say we've contributed 297,000 here, 210,000 here. The taxes that we have to pay when we take this money out as income is going to continuously grow over time. Let's just say we're in a situation where we get to 75 years old. You get to 75 years old. Now the taxes that you've paid over here is 168,000. Why? Because these are post-tax dollars. Because you're taking the money out after. This is not also including the 2% fee that you're going to have to continuously pay over time. I don't know why it's not showing the fee. I may have to play with it a little bit, but it's not. But you want to make sure you have a clear understanding on how that works. Now, over time, you want to understand how is this money accumulating over time. You're in a situation to where in the index universal life policy, if you look at the green, okay, the account balance goes up over time because you're in a situation to where it's still compounding interest consistently. Now, that death benefit is going to continuously grow. The income is going to stay the same. Now, why would that happen? Index universal life policies have what they call a guaranteed income advantage, meaning that in exchange for the money that you put in, they will say, well, you keep this money here, you will never outlive your money. In exchange, we will give you a guaranteed income for an exchange. And we will make sure that majority of the time is set up correctly. You will receive those funds as a loan. It's going to subtract from your death benefit upon your passing. This is how these particular structures are put into place. Now, let's just say, for example, here we go. Let's just say, for example, if we're continuously looking at the taxes that you're paying over time, the fees that you're paying over time, you're going to be in a situation where you have accumulated hundreds of thousands. I don't know your tax rate, but you're accumulating hundreds of thousands of dollars going out to someone else. When the entire time, the index universal, you know exactly what you're going to pay into it. So over here, you would have paid $197,000 in taxes, but over here you would have paid $52,000 in taxes. That's a big difference. Why? When you're talking about funding the policy tax-free, pre-tax. Now, if you're in a situation to where if we can go down and look at specifics on exactly how these particular policies look. I don't really want to go into details in regards to these are a lot of numbers, and I know it kind of creeps you all out. But if you want to go into details in regards to exactly how those fees look, it's because they have to make sure that the policy stays alive. The reason why you want to max fund the policy is because it offsets the fees. It offsets the actual policy itself. So this is only based on if you're putting in the minimum. You want to max fund the policy as much as possible to take advantage of what the policy design is for. Now, just like yesterday, we started with $100,000. Okay, this $100,000 in S&P 500. Then we have an index account that has a zero downturn potential. Okay, so you can't lose money, but we also have a cap. In index universal life policies, sometimes you will have a cap. Some of them don't have caps, but a lot of them do have caps. And if they don't have caps, they have what we call a participation rate. So that means that the dollars that you're putting in, they're not going to treat it as a dollar. They're going to treat it as, if it's a 200% participation rate, they're going to treat it as $200. Okay. So I'm going to say it again, especially for, I think you all need to write that down. A lot of index universal life policies have what we call a participation rate. So that means that the insurance companies will give you a bonus based on putting your money towards that particular index. These indices get huge advantages when you decide to put your money towards these portfolios. So you're going to have a full portfolio to where it might have the S&P 500, it might have the NAS 100, it might have the Dow Jones, that particular portfolio. Let's say you break it down 25% each. I want 25% of my money growing based on the S&P 500. I want another 25% growing on the NAS 100. I want another 25% growing based on another index. Let's say one of those indices, you're going to see where it says participation. Let's say that participation is going to be, a lot of times it's 200%. That means that every dollar that I'm putting, if I put $10,000 towards that particular index, okay, if I put $10,000 towards that particular index, they're not going to treat it like it's 10,000. They're going to treat it like it's 20,000. Why? Because every dollar is now worth 200% of whatever it really is. It's going to be double. Okay. Now, if it grows 10%, they're going to grow it based on whatever that participation rate is, not based on the amount of money that's in there. So that's one of the things that, of course, they don't have a visual on, but it's actually on the policy. It shows that participation rate. But we're going to just talk about the S&P 500 or in just the Dow Jones. Okay. So let's just say we got the S&P 500. Okay. In the index universal life policy, there's a zero floor. So you can't lose money. That's your floor. Let's just say your cap, majority of the time, your cap is going to be 9% or 10%. Okay. We're not going to be dramatic and say 12. It's more than likely it's going to be about 10% for most cases. Let's look at the first 5 years. The first 5 years here, first year, we started off with $100,000. We lost 10% our first year. We lost 13% our second year. We lost 23% the third year. By the time we get to year 5, we're only at $84,000. Okay. Over here in the index account, we're at 123,000. Why? Because we didn't gain anything the first year. We didn't gain anything the second year, and we didn't gain anything the third year either. But we did gain 10% that fourth year, and we did gain 8.9% as well. So you will begin to see, oh, is that right? Yeah, we will begin to see that we're only earning interest based on the growth, which is a huge difference, a big difference. These are $40,000, $50,000 differences. Now, how would it affect you over time? Let's just say we're going to 10 years. Let's say 2010, it grew 12%. We're only at $85,000 in 2010. 10 years down the line, we gain 10%. So remember, I told you we're capped out at 10% in the index universal. So even though you have a cap, you still earn a little bit more, even if you have a cap. So don't let these people convince you that the cap is, a big deal. Because a lot of times the cap isn't a big deal. The way that they get around the cap is by implementing a participation rate. Okay. So if you have a cap of 10%, but a participation rate of 200%, that means you basically made 20%. Are y'all sticking with me? Okay. Legally, they have to put a cap, but the way that they get around putting a cap is by putting a participation rate. That is how they're able to incentivize you on putting more money there. Okay. So trust me, they're very, very particular with how this stuff goes. Now, let's say, for example, you're in a situation to where we're looking 20 years down the line, 255,000 over here, 333,000. That's a big deal. We haven't even talked about the fees that you would have to pay in regards to that 100,000. Remember, you got your money in a fee-based vehicle. Mutual funds, they cost fees. Okay. These fees over time, you got this 235,000 that you have, but guess what? You pay a 2% fee on that. So it's $117,000 less. Remember, in the index universal, okay, your fees will already be paid, but it's going to be it's going to be already implemented into the policy as a cost of insurance. It's not going to affect your balance. So that's the difference between the index universal life policy. Whatever your balance is, they're not taking your fees from your balance. When you're dealing with these vehicles over here, the 401ks, the IRAs, the mutual funds, they're taking your fees from your balance. That's a big difference. Okay. That means that it don't matter what you grew, they're going to take the 2%. Over here in the index account, they've already decided what the fee would be. They already know. You've already paid it before the money even gets to the account and starts growing. All right, let's keep going. Let's even say the taxes over time. Let's just say even the taxes over time. You're in a situation to where, of course, now you just earned this 200,000. Now we got to do the math of 32%. So now you owe $100,000 in fees, and now out of the 235,000 times 0.35%, you owe $82,000 in taxes. Retirement is very intimidating, and most people don't know. That's why we try to tell people exactly how it works before they get to it, because I see people have 700, $1 million stored up, and then they're like, okay, just give me my money. And they tell Fidelity, just give me my money. And Fidelity just goes ahead and pays the taxes and takes the fees out, and they get a check for 300,000. And it's absolutely, I mean, one of the most insane things possible that I've ever seen. So there are solutions to where that you could take, even if it's too late, even if you feel like it's too late, like I've already kept my money here, what should I do? There's so many solutions that you could take advantage of. Okay. I don't want to really go into details in regards to those solutions, but there's a lot of solutions that you have to take advantage of being able to drop this tax rate from 32% to 5% or 3% or even 0%. But you have to have a team. Wealthy people have a team of people that understand this stuff. Wealthy people are in a situation where they have a group of people that understand how to operate and how to make things happen. So this is how you're going to beat the game. This is how you're going to be able to get around the people that are the majority that are just saying, okay, let me just pay the taxes. Let me just do this. If you were a good business partner, with the government, you would know exactly what vehicles that you need to take advantage of. Okay. So I know we're wrapping up. We got about 2 minutes. I've seen some questions. I know I'm going to have to, these are conversations I already know, Princess, we're going to have to sit on the phone. I know you're a little bit more advanced than everybody on the call. So we're going to have to do a little bit more deep dive in regards to what you're saying, because I don't want to confuse anybody at all. I know what you're saying, but I don't want to confuse anybody. So we have probably a conversation offline where I do a loom for you, but definitely if you got some value, drop some fire in the chat. I know last day is tomorrow, so we went over index universal life policies today. Drop some gems, of course, in any of the groups or whatever, to so you can know exactly what you have. And I think one of the biggest advantages to where even if you don't set it up, to encourage somebody else to set it up for themselves, to encourage people to, hey, I know your job is offering you this 401k with the match and all this other stuff, but I want, let's do a comparison and let's look at what are the fees that you're paying over time. Like, talk to someone to really see what are the fees that you're going to pay if you continuously go down this rabbit hole. Because the compound interest is amazing, but the biggest problem is you being in a situation where you're going to have to continuously pay on that over time. Okay. And there's also buyout fees for the higher participation rate. Will those be taken from the balance? So the participation rate, is it going to be those buyout fees? So when it comes down to the participation rate, you're going to be in a situation where when you get your statement for that particular year, they have different rates that they would do because it's based on whatever they negotiated for that particular year. So it's not going to be a specific fee over that time frame. But one thing I will tell you is that they do show favoritism based on people that have overfunded their policy. Because let's say, for example, if your policy is far from lapsing versus close to lapsing, that's why you want people to put more money into the policy. Okay. That's why we tell people, hey, put more money, max fund it, because over time it will perform better. And the better it performs, it will outdo not only the fees will be offset, and a lot of things will perform a little bit better. A lot of the times when you're dealing with these vehicles, they're babies. They're new, like 20, 30 years old. A lot of these insurance companies are new to these types of products. They really don't like them. They like whole life products. These products are very, very new. So you want to be very, very careful with who sets it up, because they have to be set up properly. I've seen people lose thousands and thousands and thousands of dollars in index universal life policies because they think that they could just sit the money there and then it would just compound over time. If it is not set up properly, if the fees do not become offset over time, the policy will lapse. When the policy lapses, of course, that means that it crashed over time. So it's just like purchasing a property and not paying your property taxes, and then the government just go ahead and snatch that building from you. It's the same exact example. So you want to be very, very tedious with who you allow to set these up, because the language is very important. The language between what you're negotiating between the insurance company is very important. Everybody can't set these up. Everybody's not trained to set these up. Everybody has no idea what I'm even talking about. I will tell you about, not if I sit in front of 95, 99% of agents, they have no idea what I'm even talking about. They don't look at the illustrations. They don't know what an illustration is. They have no idea at all. And when I sit in front of people, they're like, oh, I got my index universal. I've been paying $300 a month for the last 10 years. And I'm like, you have no money in it. It's like you go into the car dealership and you go buy a car. You're so excited for the car. Oh, I got this new car, but your interest rate is 30% or 20%. And you're going to be paying on interest for the next 7 years. And you're like, oh, I'm paying my car off. No, you're paying the interest on the car. You haven't even started paying the car off. So it's the same exact model when you're dealing with these policies. Most people are paying into the fees. Most people are paying into the fees of the policy versus paying into the account value. But they have to be set up correctly, and everybody's scenario is very much different. So thank you all for staying on. I know we got to get off tonight. So see y'all tomorrow. I know it's a new link. I just figured that out. It's a new link every day. So make sure y'all are on, and hopefully you all have a great night. Thank you.